All right. Hello, everyone attending online. I know that you can hear me because I can hear it across the room. So just while people are logging on, we'll just do a little bit of housekeeping for the online portion. So for those people who haven't attended one of our hybrid seminar sessions before, we have some wonderful people here in person at the office, and then those of you attending online as well, which is great to see, and we like to be able to offer both, but it does come with obviously some technical challenges, so do bear with us as we switch between Teams and screen sharing and all the other things that need to happen. Please do stay muted throughout the session, and if you have any questions, just pop them in the chat box and Laura will be able to ask them on your behalf, as she'll be monitoring that chat box and she'll be able to ask them in person. If you have any questions throughout the session, please do put them in, and we will be recording the session as well. And we will send the recording to everyone who registered to attend. So if you miss anything for any reason, bad internet, whatever the case may be, don't worry, because we'll provide copies of the recording and the slides tomorrow. So to begin with, I'll just say that firstly, we'd like to acknowledge the traditional owners of the land on which we gather here today. So the Wurundjeri Wurrung people are the traditional owners and original custodians of this land. And we want to pay respect to their elders, past and present, and we extend that respect to anyone of Aboriginal descent who is here today. So without further ado, I will pass this off to our wonderful Director of Aintree Group Wealth, James, who has been with us for a year now, since the launch, about a year since the launch of Aintree Group Wealth, and he will be taking us through all things financial planning. And yeah, over to you, James.
Thank you, Chelsea. Welcome, everyone. As Chelsea said, I'm James. I am Director of the Wealth Division. And today we're going to be talking about financial planning. Now, the reason why we've sort of titled it as we have is a lot of people, when they think about financial planning, what they think about is investing. That's the typical thing. Oh, I need money to invest. The plan is going to invest. Now, whilst that is a component of what we do, it's not the whole thing. You can, in fact, we've got plenty of clients who we look after who don't actually invest with us. They might have a stockbroker, they might manage it themselves, or they might just have their superannuation fund outside of our control in terms of the investments, but we can still help them plan to achieve their outcomes. So that is what we're going to focus on today. Obviously, there are some things going on in the markets, and we do get a lot of questions about that, so we can never really avoid it. If we have time, we can discuss what's going on in terms of the bond markets particularly, and you know, the effects of the rising interest rates. But I'll try to avoid that because that can be a little bit dry, and we'll try and make sure we have the sort of the more exciting stuff, if you will. I mean, really exciting to me, but so let's move on. So firstly, there's the usual disclaimer. Realistically, what the disclaimer is just saying is that, you know, we don't know your personal circumstances. So anything you see today, you can't assume we're directing it directly at you. For obvious reasons, it's general, and if you want specific information pertaining to your situation, that's where we take you through it. But other than that, just treat it as what it is, and hopefully everybody can get some learnings out of it. I'll try to add some bits to it where you sort of take something out of each component, and there's something that you can go, wow, I didn't know that, or that's useful. So we'll work our way through it and see how that goes. So the quick introduction, we're going to look at Aintree Group Wealth, what we're all about, and then we're going to look at, you know, the fact that under Aintree Group we have different divisions. So the idea is to collaborate together to be able to solve the whole problem rather than addressing little bits at a time, which can be dangerous because you can have a great financial plan, but if it's not integrated with your accounting and your legal arrangements, it might fall over when it gets tested, and that does commonly happen. And it doesn't have to be those areas. It could be your finance. You know, you could have a financial plan that works really well, but you go and get finance and it doesn't work in with the plan. So if we can get everyone in the same room talking about your issues, and addressing your specific requirements, you're going to get a better outcome. And that's really what we're trying to do with the collaborative approach. And within wealth itself, we have three main areas that we target, and that would be strategy, which is the big picture, and then we'll break it down into your wealth management and your risk management as well.
You should be able to just do the arrow keys.
Right,
so you don't
there
have
we
to
go. I'm learning on the go here. It's a new experience working on the laptop. Okay, so I suppose if you want, in a nutshell, we help people make smart decisions about their money so they can live their best possible life. And that's important because there's so many decisions people have to make, and if they can at least have someone helping them make smart decisions, then they're going to get a better outcome. Or at least that's what we're trying to do for them. And we'll do this, we'll use wealth creation strategies, that's pre-retirement, post-retirement, where we're looking at helping people hopefully increase their income, decrease their expenses, which obviously would entail them saving more, therefore they can invest more or pay down debt quicker. And also just make sure there's a security blanket over them in case they run into any disaster, like their plan B, which would be your insurances and your legal estate planning agreement to make it all work together. So that's it in a nutshell. But ideally, I suppose if we want to break it down even more, just to make it easy to sort of visualize what financial planning is, it's people are at a position in life right now and they want to get somewhere and they're not sure how to get there. That's our job, to work with them to help them get to that destination. Now, there's many different roads you can go down to get to a destination. But our job is to work with you to get one that you're most comfortable with and one that works in your life.
There
we go.
we go. Is it working?
Oh, sorry, just
that's all right.
Tweaking our way through
There
this.
we go.
Okay, so why would we put a financial plan in place? I think that's an important component of a financial plan. Financial planning is having the plan, because the plan is going to help you build a strong foundation, and it's going to articulate it. It's going to articulate where you are now, where you want to get to, and all the different strategies in place. And that way we can work with you over time to make sure that you are achieving those goals. Because if your financial plan is to retire at age 50 with a certain amount of wealth, we want to make sure that we've got the strategy in place to help you get there, but also each year make sure you're on track to achieve it. Because if your financial plan calls for you to have a certain amount of money 10 years out from retirement and you don't have it, well, that's where we can work with different strategies to make sure that you can, get back on track. Because things change. If it was as simple as you had a plan in place, you started, and then it worked out all the way through, well, we wouldn't need to keep tweaking our plans. But life changes, and it could be anything, your personal circumstances, it could be legislation changes, it could be the markets change, you run into a GFC type event, and all of these things can conspire against your plan. So the idea is we just want to just keep working with our plan. So if it gets off track, we can get back on track, and then you can achieve the outcome you're after.
There we go.
And another picture here, which I think sometimes just makes it a bit easier. So the way we like to look at our planning process is we want to break it down into two bits, the why and the what and the how. So I think the most important part is to address the why bit, the meaning of the plan, because when you're trying to achieve a goal or a particular outcome, it makes a lot of sense to dig down a little bit deeper to understand why you want to do that. It's all very well saying I want to retire at age 65, but why? Like, what's the purpose? Like, do you even need to retire? What are you going to do when you retire? We want to know why, because then we can tailor the plan to you. But also, when you have to make decisions along the way, bringing it back to your why helps you make those decisions. Because if there's no real meaning behind it, you're not going to achieve it. But once people have meaning behind something, they can make the sacrifices. If they want to retire a bit earlier, they will make the adjustments. I mean, I've dealt with people in the past where, their why is not strong enough. And when their why is not strong enough, they'll happily put it off for another day. Where they're supposed to save a certain amount this year, they'll say, oh, I need to go on holiday, so, I'd rather do that. And rather than doing what they need to do. So an example of that is, we have a lot of people when they retire, particularly, I mean, from my experience, particularly the females who are really close to their children, want to have a major part in their grandchildren's lives. And an example of bringing meaning into it is when we ask, why do you want to retire? Like, why is it important to you? Someone might say, well, I want to spend as much time as I can with my grandkids. It's really something that means a lot to me, and I want to do it at a certain age. So what we want to do then is, now we've got the meaning, so now we can put the strategy in place, and that we can always refer back to that whenever we need to make a decision that will help that person make the hard decisions sometimes if they need to. But it'll also help them make maybe save a bit more, take a bit more risk in their investments, spend a little bit less if they want to bring it forward. And we'll speak, if we can, a little bit later on, we're going to do some example of some modelling to show you how we would go about those trade-offs, to show someone how they can achieve those goals visually. Okay. So, and then below the line is the specifics of what your financial plan does. And that's where we look at, where do we put the money? Are we putting it in superannuation? Are we putting it in a family trust? Are we putting it in investment bonds? Are we investing in shares, property, cash, fixed interest? What are we actually doing with it? It's getting to the nuts and bolts, but obviously that's the below the stuff that comes after the above the line. And then a lot of people, this is why I wanted to bring it back to not specifically about the portfolio, because when you're all about the portfolio, everybody's always thinking about what are we putting in there? Should we sell this share? Should we buy that share? Why don't we have a bit more money in the US? Or why don't we buy a bit more commercial property? Those are all those sort of end decisions. But with financial planning, there are the things that we do can add value, the strategic things on their own. And I want to take people through how we do that, so you can see the additional value that you'll get by going through a proper financial planning process. As you can see there, that Russell Investments is a major investment house globally, and they've done some research on where advisors can add value. Not all of it can be articulated in a specific percentage. That's why you can see some boxes there that have been checked where they have been able to articulate it. Other ones depends on the person. So it really depends on peace of mind is something that everybody gets different level of peace of mind. Some people worry a lot, other people don't. So they have a different amount of value in that area. And other people have a lot of complex decisions they have to make in their lives. So for them, the choices and trade-offs is important. It makes they will get a lot of value out of that. Other people with simple lives, simple plans, for them, choices and trade-offs don't really matter as much. So it does depend, but in the top three items there, in terms of asset allocation, behavioural coaching, and tax-aware planning and investing, can add up to 5.8%, according to Russell. And I'll take you through how that's the case. Okay, after I just cover off, I think we mentioned before, the three pillars is our strategy, our wealth and protection, and that's how we'll take the presentation through one at a time. So first and foremost with strategy, you can see that it's important, as I mentioned, with the collaboration to bring everything together, because you can't just focus on one area, like for instance the investment and super, and not address all the other areas, because they all link together. Like with your super and investment, your estate planning ties in with that. Like, where does the money go if something happens to you? Like, what's happening there? Or if you've got goals to retire comfortably in 15 years' time, but one of the people, like the husband or the wife, one of them gets sick and can't work, where's the money going to come to fund that retirement? And that would come from an insurance component. Or in terms of retiring on a certain amount, maybe you're not going to be able to be a self-funded retiree, but that's where the Centrelink age pension comes in. So how does that work with your plan, and how do you access that, and how much you're going to get? And all in terms of the actual underlying bits to achieve your goals, the cash flow. How are you going to save the money? How are you actually going to get that money? How are you going to budget your spending to save some money, to invest, to achieve the goals? So if we don't look at all the different components, we're not actually going to be able to achieve a good financial plan for someone. And in the heart there is the tax, because the tax affects all those areas. So obviously that's not an area I specifically work on. It's Shane and the guys does that. But it's certainly important that we are aware of it, and where possible we can make sure that the strategy is tailored towards being tax efficient. And we'll cover off on that a little bit later. But that's just important to understand the strategy side of things. And in terms of, if you look at all those components that we just discussed, they all have an optimal way to be. So, with the cash flow and debt management, you're living within your means, you're accumulating savings, you're putting it in the right place. If you've got debt, mortgage debt, or any debt really, it's at the best rate you can get. It's structured in the best possible way to achieve your outcomes. Goal funding and retirement, we've covered on that, but that's literally making sure you've articulated what you want, how much you need, and also are you on track to achieve that, which is what we do with our modelling later on. So we won't go through each bit, but effectively an optimised strategy takes care of all those areas, and each one of those areas has the preferred way to be.
We jumped ahead a bit.
Jumped out. Let's move that.
Oh, hang on.
Apologies. This is.
There we go.
I'm supposed to do it at a relative pace, but I think I might have jumped forward about 10 slides.
There you go. That should be. That's the one you should be on.
Okay, so if we look at the optimized strategy, the first area where we spoke about value add is choices and trade-offs. Now, for everyone, it's a little bit different, but as you can see here, most people have lots of different components to their lives, whether they're in the accumulation phase, so they're not retired, they're still with the family planning, they've got the kids, they've got working on their careers, they're trying to budget all that, they're trying to educate the kids, they're trying to go on holidays, trying to save for retirement, trying to pay down the mortgage. So that's all those trade-offs they're going to have to make. Preservation is when you get to that. The plan B bit is making sure nothing goes wrong. How are we going to manage that? Because the costs of, it's all very well to have the best insurance plan, it's all very well to have the best retirement plan, but not everyone actually has complete sort of the budget to be able to support it all. So we need to work out in what ways can we optimize it for you. And then of course there's the final bit, and we want to make sure that we've got all that sorted out. And with the estate planning, that's where you bring in the lawyers to make sure that the funds get distributed in the most appropriate manner to the people who need it at the right time. So it could be that you've got a large estate and you've got 3 children, and 2 of them perfectly able to look after the money when they receive it. There might be one who's not in the right frame to receive it. Could be they're going through a marital problem, or they might have bankruptcy issues, or they might simply not be able to manage money. There are plenty of 18-year-olds that probably shouldn't be receiving a large amount of money. So I think we can all sort of identify with that. And just sort of expanding on the trade-off side of things, you can see that when we're looking at the trade-offs, it does come down to a lot of different areas, such as your circumstances. Where are you right now in your life? Your preferences for the type of risks you like. Some people are risk takers. Other people, risk isn't their thing. They'd rather, if they could, they would just leave it all in the bank or put it under the mattress. They just wouldn't do it. But that's where the education and the trade-offs come in, because whilst it's nice to take zero risk, the odds of achieving your outcomes may be very low, because putting money in the bank is not really going to generate the type of return someone's going to need to retire comfortably later on. And and we also have to consider things like rising inflation at the moment it's relevant. It hasn't been for the last 15, 20 years. It's been sort of subtle, but now it's in your face. I mean, wherever you go, there's inflation, and therefore we need to make sure that those assets we invest in will deal with that. So there's a lot of different things we have to consider when we're doing these trade-offs, and it's unique to everyone. So it's not, none of these fits anyone in particular. However, that is part of the value add, is helping you make those decisions. And a secondary part of this is where we use what's called a lifetime cash flow modelling, and this is where we basically take all your current assets at the moment, put it all together in a financial model, and we work out where you want to get to, and we demonstrate visually that whether you'll be able to make it, you won't be able to make it. Do you need to save more? Do you need to spend less? Do you need to work longer? Can you even retire? You know, there may be the odd person that can never retire. So we'll prep you for that early and tell you that it's best to.
Are you ready to do the?
I'll just go once. I'll just show one more slide on that one. So the first slide here we can see is just a high level one is this person, a lot of people come to us, and our experience has been that they'll come in and they'll have a lot of assets, but they'll still feel like they can't retire comfortably. They'll still be worried, is this enough? Can I retire? Will I run out of money? And in this is the type of modelling exercise we'd do with someone and demonstrate to them visually that for all your assets you have now and how long you've got to live and how much you want to spend, you have no chance of running out of money. You need to maybe consider the options of spending more and like having more fun with your money. And that's reassuring to people. It's a peace of mind thing where they go, oh, I'm okay, I can retire. Like I've had people in the meeting where they've literally gone from just not having a clue to the next day or like at the end of the meeting going, I'm going to retire. Like that's it, I'm done.
You click on that one.
So and this is an example here. So we can then say to that person, well, we can spend not the person who didn't think they could retire, but someone who's got plenty, you can spend more, and let's show you how much you can spend, or you can give some money to the kids, or however you want to go about that distribution, and we can manage it so that we don't give away too much or spend too much so you run out of money. You'll still have a bit at the end. And that's that peace of mind piece. That's the high level. Now I'm going to attempt to do some crazy, reckless maneuver of actually doing an example cash flow modelling. It's just
this is what we want
a few
it to
screens
be.
we've got to play around with.
Oh, hang on, we got to log in again.
Yep.
Laura, can you confirm if you can see the? Okay. That's not what we want.
And you said the model, let us know when the modelling software is ready to go.
Stop sharing. Share. Windows. We did a test run on this.
Yeah.
But
it's technically possible.
How are we looking now?
Yeah.
All right.
Okay.
All right. Now we've got to do it in here as well.
Okay, yes.
Which you may also need to have to log in again. No, there's a timeout issue.
Okay, just extend that session and then.
Lots of we love cybersecurity until it logs you out after 5 minutes, and there we go.
Yeah. Okay. All right. So here's an example of a simple one. Obviously, I didn't want to make it too complicated. Too many variables can go wrong in these type of examples. So what we've got here is some clients have come in. They're in their early 40s, and they want to know they want to do some financial planning. So the scenario they've presented with is that they've earnings are 120 each, so it's two people working. They've got a bit of savings, so they've got 30 grand in the bank. They've got a couple of super funds, 100 grand each. They've got a property, $800,000 value, and $500,000 debt. So that's their basic setup, and there's a couple of expenses in there that we addressed. Their living expenses, which is $100,000 a year, as well as there's a planned expense of a holiday in about 4 years' time. Now we can add a lot more things to the model, but for the simplicity's sake, that's where we're at. And I'll just show you here on our timeline. We've got our plan is starting here. We've got the holiday planned over there. Potential education, I haven't put the funding in for that yet because they haven't got any kids, so we don't want to sort of jump the gun at this point. But they've got a holiday they want to go overseas in 4 years. They want to retire over here, one of them 65, one 63, and then we've just run it out to a particular mortality age. You can put whatever you want. I've put it in at the sort of default one. I always go through people's sort of genetics and all that sort of stuff to, well, just to make them feel comfortable, because some people go, oh, my grandma lived to 100 and my grandfather lived to whatever, and then like they wanted to run longer, and then I've got another client who's convinced she's not going to make it past 80. So, it's different, horses for courses, but that's a good starting point there. So we go back to the dashboard there, so we know what those little signposts there are. And you can see here now the issue we've got is we've got some red. Red means shortfall. Red means we're not going to have enough to be able to do what we want to do. We're going to run out of money here effectively. That's our issue. Now we want the red to go away. So that's our planning. That's our objective. They're happy with everything else. They're happy with that working to 65 and 63. They're happy with their holiday. They're happy with their spending of 100,000 a year, which gets indexed, so it's not going to remain 100 all the way through. And what can we do to fix it? So let's look at just some simple strategies that we'll use in the modelling. We'll go up to our insights, and in our insights, what the software allows us to do is solve problems rather than just using ad hoc, changing little bits and seeing whether it works or not, and eventually we get to the answer. We ask it for the answer. So one way we could do it is we could say, well, what rate of return do we need in our investments to achieve our goals, to get rid of the shortfall? So we go to our rate of return calculator, and we'll go with a get started on that one, and it's going to crunch the numbers for us. And so, can you see that? Yep. So the rate of return that it's suggesting we need to achieve the outcome, where we've solved the red largely, is 6.81%, which is not unreasonable because our current return expectation for a balanced portfolio, which is 50% growth assets and 50% defensive assets, that's cash and fixed interest, is around about 6.11. So 6.81 is not unreasonable considering they're 41 and 43. They've got at least 22 years to retirement, so they would be at least growth investors, especially because it's in their superannuation. So 6.81 is the required rate of return for that option. So, but they might surprise us, and they might go, well, you know what, we're a little bit more conservative than all that, so we don't want that. So perhaps we can look at another option. So we can have a look at, let's have a look at how much they need to spend in retirement. Maybe the 100 grand in retirement is too much. So let's try another option here. So we'll go in there and we will get started, and we'll look at how much spending they can do in retirement. So originally it was 100 grand, now it's down to 80. So these are the trade-offs they're making now. Do you want to take a bit more risk, or do you want to spend a little bit less? We could do a combo, or we could retire a little bit later. That always will add a lot of value to the long-term plan. So there's a lot of different things we can do. We haven't addressed earning more money, spending less. We haven't addressed setting up an investment strategy. We haven't addressed any of those options that we could do to enhance their situation. All we've done is simply looked at some basic scenarios that will improve their plan. And just by making those small changes, they can feel like they're on track to achieve their goals. Now, as you can appreciate, there is a lot more that goes into the model than that. It's just, this is not the purpose of tonight. It's to show you that you can sit down and you can have your financial position mapped out, and you can talk about all the things that are important to you, and we can model them in there, and we can come up with ways to make it work for you. Maybe you want to give an early gift to your kids or your grandkids, or maybe you want to consider private school education. These are the things we can play around with till we get to the point where you can have it and you can retire comfortably, or it might mean that you're going to have to do some different things to be able to have it all, because it's not always as simple as, we can't turn water into wine, so to speak. We can do what we can do, but there's a limit. But just one last thing on the insights, which is kind of useful. When we do our modelling, what we can do as well is also look at things like what happens if we have a market crash, or we look at different volatility levels, how that affects your plan. Because one thing we know is the future isn't certain, and especially with investment returns, we can retire so-called comfortably at one point and walk straight into like a GFC event, and that has a major impact on people's ability to retire comfortably. If the way you set up a retirement portfolio, if you do it in a way that doesn't address the potential downturn early in a retirement strategy, you can run out of money much easier than someone who addresses it and has that event happen to them later on in their retirement. So it's just the way you do it, and it's a relatively simple. It's just making sure there's a couple of years of cash available, so that if you ever run into a downturn, you don't need to sell those assets at that point. You can live off the cash for a couple of years, because typically any bear market, there's obviously going to be exceptions, but historically, after a couple of years, things are starting to pick up. So if you can avoid selling those assets at that point, and that's a sort of difference between a retirement plan and a normal investment plan. Because when you retire, for most people, no new money's coming in from employment. You've stopped working and you're relying on your assets. So we have to have a different strategy from those who are employed. So there's many different things we can play around with, and that was just an example. So we're going to jump back into the presentation.
Now comes the moment of truth. Bear with us.
Okay. Here goes Chelsea here as my head IT.
As we go back. So we're going to stop sharing there, and then we're going to go back to here. Nope, that's not the one I want. Here. Try again in Teams. Present. And then we're just going to jump forward to, and Laura, can I just confirm that you can see the slides again? Perfect. And then we're just going to jump back to here. Look at that. Seamless.
Yeah, no, that's good. I wouldn't have been able to do that. Okay, that's really good. So the next pillar is the wealth side of things. Some of these bits I'll move through relatively quickly.
Yeah, I'm just checking our battery situation. Yep.
Solid 27%, yep. Chelsea. So we'll start when we start with wealth. We just want to start with the basic wealth building principles. Is obviously you want to have goals and objectives about what you're trying to achieve. You don't just start investing just to invest. Like why? That comes back to that meaning. In terms of our investments, we want to make sure that we use appropriate diversification. We also want to put it in the right asset allocation, and we're going to get to that in a minute. That's why I'm not going to spend too much time in this area, but these are just the 4 bits we're always looking at, is making sure we've got the right goals and objectives, we've got the right diversification with asset allocation. Keep your costs low, because costs matter, all things being equal. A higher cost portfolio won't perform as well as a lower cost portfolio, assuming all things are equal. And of course, discipline. We'll talk about that too, because discipline is another component where we add value, and that's that behavioural coaching. So we'll demonstrate that as we go through. So we've mentioned what that is. We can move through. So the appropriate asset allocation. So this is one of the components where you can add value. You don't have to specifically invest on someone's behalf, but getting their assets in the right buckets can make a big difference, especially with retirement savings. Most people with retirement savings will not make any decisions with their superannuation. They will join a super fund and do nothing. They will just tell the employer, this is my super fund, and here are the details, and they'll start paying in there. And what that means is you'll get whatever the super fund set up for you. So typically it's the balance fund, and the balance fund, whilst the reason they do it is they don't actually specifically know who you are at the time. They just literally put you in. There are some new ones where it's a lifestyle, sort of life stages option, where it depends on your age is what investments you get. But still, it doesn't mean it's appropriate for what you're trying to achieve. And an example of how this can matter is that depending on we'll demonstrate it here. So here's an example of asset classes themselves. As you can see, the asset classes range all the way from cash all the way up to the best performing over the last 30 years was the US shares. But those are all the different components that could go in a portfolio. And how you mix them up will determine your rate of return. So if you end up in a lower return investment option just because it's the default option, it could severely underperform what you could be doing if you just were in your correct portfolio. So that's where the 1.6% comes in, is because a lot of young people would be in the default option. Really, they should be in a high growth option. So they're missing out on a lot of returns, and those returns compound every single year. And if you're 25 years old, that's 40 years of compound. And I'll give you an example of just how big that difference is on the next slide. We've got the last 52 years of asset class returns. So that's it's seen a few cycles. And I'm also, the reason why I'm showing it like this is actually a different view. You could have this, you don't have to have it like this. It could be smoothed out, that yellow US share line. But the difference between over the last 53 years between, say, Australian shares and other international shares, excluding US shares, is not huge in a percentage terms. I mean, it looks like it's about 1.8. Can't quite read that, but about that. And 1.8 is not much difference to the 1.6 that we mentioned before in terms of the value add. But the difference in the rate, the total return is massive over that period of time. And that's almost, well, I mean, it is largely someone's superannuation experience, 52 years, because, you start at 18, that's going to take you all the way to, say, 70, and even at 70, you're still maintaining it all the way through, unless you run out early. Now, there's another reason I brought that in as well, is because we're going to talk about the next slide is around diversification. So now diversification is important because this is why we don't put all eggs in one basket. Like we looked at that chart and we thought, US shares are fantastic. I should get my money there because look how well they did versus Australian shares. But, every asset class has their day, and some of them have their decade. And in the case of US shares, they've had a really good decade, because where you saw that chart zoom up, that was pretty much around about 2012 to 2022. That was a 10-year decade, and it made a hell of a lot of the difference. And you can see on the actual chart, if it's clear enough, each asset class is listed there, and it shows their return for the year. And then obviously every year it's different. We don't know what they're going to do the next year, the year after. And if you go back to the US shares, the first decade of the 2000s was very poor. There was a lot of negatives. So the people who had their money there wouldn't have been too happy. The people who have had it after the GFC are really happy. But that doesn't mean it's going to replicate the next 10 years. So why we need to be diversified is because we don't really know, but the asset allocation means putting your money in the right assets for what your plan's calling for in terms of your objectives, plus also what you're comfortable with and your risk tolerance. So that's kind of, and this will summarize another component of the 1.6 side of things, is if you look at the last 10 years of the different asset classes, well, not different, what they've done with these funds is they put together some assets into a portfolio for different risk tolerances. So if someone's really conservative, they'll be in the conservative option. So they don't want too much ups and downs. And if someone's risk taking and comfortable with a bit of extra risk and wants more shares, well, they're in a different basket of assets. And you can see that the difference between the last 10 years in conservative and high growth is significant. So if you're just in the wrong one, or even if you're in the balanced one, it's 3% over 10 years. It really adds up. So that's where we get that percentage from, the 1.6. And just one last thing around that percentage is, when you're looking at super funds, it's really hard to compare super funds, because what you see are these top performing funds each year in the balance category, like who are the best funds of the year, and this is what we should invest in. But the problem with those funds is it's not actually how they break down their investments and what categories they put them in. They are not required to disclose any of that. So even to ASIC. So we just have to take their rate of returns and their whether they're a growth asset or a defensive asset at face value. An example of why that's not a great thing is, we'll start with what's a defensive asset. ASIC defines it as government bonds and cash. And we add gold to that as well as a defensive asset, because these are assets that realistically, when the share market goes down, they should maintain their value or go up. And that's their purpose. But according to some funds, there are other assets that are defensive. So you could have some shares like Telstra, like utility type shares, like the gas companies that are seen as safe, defensive shares that pay regular income and they're not going to be too volatile. Now, for large periods of time, they probably are, but when the markets fall heavily, they all go down. There's no safety in the share market when you have like a COVID or a GFC. People just want to get out. So it doesn't matter whether you're in a Telstra or you're in a CBA or BHP. And they also have other ones like infrastructure and property. So these unlisted property trusts, the buildings in the city or shopping centres or things like that, some of them are not listed on the share market. They're owned by the big super funds. They're unlisted, so their values aren't publicly available. They're just valued from time to time at a rate the manager's comfortable with. Now, and it's very hard to actually work out what that actual value is, because it's their value. That's the one they do. And if we go back in time, we had the GFC, the property market, the listed property fell quickly, fell 75%. It was quite clear what the market thought the value was. But where, on the other hand, some super funds held a lot of unlisted assets that weren't listed on the stock market, like MTAA. And that asset, they in fact they had to merge in with another fund. They went from the best performing fund to the worst within a year. So that's an issue. And at the moment, a lot of these super funds have these unlisted assets sitting in their portfolios, and they're calling them defensive. And the problem with that is, if you're sitting there thinking, well, I've got a nice appropriate asset allocation, but you really don't, because you have risky assets in the place of defensive assets. So an example of a top performing fund now, they claim to have, I won't name any names on this fund. I don't want to get in trouble, but they claim to have 24%. This is their balance fund. So balance, meaning their sort of medium risk fund, 24% of defensive assets. And of those defensive assets, only 5% make up cash and fixed interest. So 95% are either in shares, unlisted property, infrastructure funds, private credit, venture capital, all of those things, which, while times are good, gives you some good returns. But when times are tough and rates are going up and valuations are changing, it doesn't look as good. So if they have to revalue at some point, that could be a problem. Obviously, they don't want to. As an example is that one of the big super funds was trying to sell a large building in the city recently, and they put it out for tender, and all of the bids came in way lower than the value they got on their books. So rather than realising it and then exposing that to the market as a change in fortune, they pulled it. So no one actually knows what the value hasn't changed. In fact, some of the values of these unlisted assets have gone up, while the value of the listed ones have gone down. So, we have to be careful of that. That's one area. Behavioural coaching, that adds about 2.9%. So this is an example of what happens when people fiddle. Now, a lot of people fiddle with their investments, and this is one area, if we just could help people not fiddle, that could contribute to about 2.9%. That's the difference between the average investor over the last 20 years in the US and the person who just bought the S&P 500 and then just wandered off for 20 years and came back. That person was 2.9% better off than the person who was looking for the right time. Like, is it a bit overvalued? Should I put some money into cash? That's the sort of talk I hear from people. But the point is, it's very hard to know when the market's going to the market's going to turn. It doesn't. There's no like bell that goes off and they say you guys have got another 2 weeks to sort things out and then we're going down. It just goes down. Like, here's the GFC, went down there. There's COVID. So it just happens. So the idea is, what we're trying to help people do is, your asset allocation requires you to invest in these assets whilst you're scared right now that the world's falling apart, because it fell apart in COVID and everyone was really scared, and it fell apart in the GFC and everyone was really scared. The tech wreck, they were really scared. But these things sort themselves out over time. And perhaps for some people, if they're really concerned by markets falling, they're in the wrong investments in the first place. So their asset allocation is wrong. You shouldn't be having trouble sleeping at night. If you get to that part, it's the wrong mix. Then we need to go back to the model and do the trade-offs and say, well, we need to put you in safer investments for your peace of mind, but you're going to have to trade something off later on because of that. And that's the awareness that exercise brings.
Can you go back to that one just very quickly, James? Just to explain the on the side, I think it's really important, the number of bull years versus the number of bear years. How long those cycles go for?
Well, the bull markets go for a significant period of time. As you can see, they'll go for like possibly a decade plus. And with those bull markets, the way it works is the markets go up and up and up steadily, but at a relatively calm pace. It's not quick. It might seem quick from certain days, but over the period is 1% here, 1% there, little fall. But over time, you get your 10, 11%, and it's kind of smooth. The bear market, it falls quickly. When the markets fall apart, you'll see it, and it'll be 30% in a month, 2 months. We saw the GFC, if you all recall that. I mean, I recall that quite vividly. It was, I remember the September, October 2008 when the AIA or AIG at the time was falling apart, and Lehman Brothers, and it did seem pretty dire. But that market fell about 50%. So, I mean, 50% it fell in half, and that was the beginning of the next bull market, but it fell quickly. It would have fallen over a period of probably, if I recall, it would have been about a 6-month period before it bottomed out in March 2009. So it's small versus 10, 15 years. So there's a big difference in the two. So in fact, the safest time to invest, this is where we want to really get people to invest, is when the markets have fallen heavily. Most of the risk has come out of the market. If there's ever a time to invest, it's then, because the downside's getting less and less per day. But at that point, nobody wants to invest. Everybody says, we'll wait for, let's just see how things go. We'll maybe if it gets better, we'll get back in. The problem with that is, you miss the best days. The big returns over the long period of time are in days. You'll get certain days you can't predict, but they happen. So over the last 10 years, if you miss the 40 best days, you've just missed out on 20% of the returns. just 40 days. So that's all it is. But the thing is, you don't know when those 40 days are. And while you're waiting for the markets to get better, by the time because what often happens is people get out and then they relax. They go, I'm out, no more pain. But by the time they start looking at it again and they start hearing people talk about it, the markets have already, most of those losses have already accumulated, gone away. And now you've missed out on the upside. So you've taken all the pain going down, but you haven't hung around to get back to normal. So that's part of the behavioural coaching, is just saying, right, don't do anything stupid. And if you are going to do something, let's do this. Let's do regular investing. Just keep putting money in. And the best time to put it in is when it's fallen. But this is just the power of just regular contributions versus doing nothing and just putting 10,000 in. So you put money in over that period of time and you're going to get a better outcome, because you're going to be buying in low because it's just regular. That's what super does. And most people can forget that that's what they're doing with their super. They're dollar cost averaging every month or quarter. The money's going into your super fund and you're not even looking at it. You're just buying. And if it falls, you're buying cheap. But when it's somehow outside of super or their pension, they don't want to know about it. Okay, so we obviously, and we'll just move through this one quickly. This is the 1.3 on tax-aware planning. It just depends on how you set things up. You can set it up for a better outcome. Some other things we'd look at typically would be, and we're not going to go on them tonight, but do we invest in super or outside super or SMSF or just a normal super fund? Do you want an ethical approach? Because there's plenty of good ethical managers out there now, which are very competitive. People in the past have worried about it, thinking they're missing out. That they haven't been, because these managers are, maybe they got rid of some energy type investments, but they got more healthcare. So the trade-off, or IT. So their trade-off is not such a bad thing, and in fact they've done quite well over the period. So we'll go through all of those different things. Now, it doesn't mean we'll recommend them. It just simply means we'll look at them and see if they're appropriate for someone. So that's kind of that. That's where we add that value in the specific stuff investing. The protection, the plan B side of the equation. What we want to do is, as part of that collaboration we spoke about, we always want to make sure that someone has their estate plan in order and make sure that they've got which is their wills and powers of attorneys. You can go into more depth, but effectively you've got that. Your superannuation beneficiaries line up with your estate plan. Your insurance is got the right beneficiaries. Just getting it all coordinated together just means it'll work. Because otherwise you could have the best estate plan in the world, but there's no assets because the house is jointly owned. The insurance is gone off to your wife or your kids. And so there's no actual personal assets to go into the will, into the estate. So with the legal team, you would get the right estate in order, or at least the documents, and then you point everything to where you want it to go, and then it would work. So you don't just want to get a will and power of attorney and not consider everything else. Of course, insurance, we won't dwell too much on that side of it.
We'll be mindful of the time.
Yeah, we're mindful of time, so we're going to zip through the insurance and just say, it's there to fill a hole. If you don't have enough assets to be able to utilise at the time, insurance's job is to provide you with immediate assets to be able to help you out when you need it most. Different types of insurance, we know there's life insurance, total and permanent disability, trauma, and income protection. Won't go into all those details because of time, but there are different ones, and getting a good insurance plan just means you've addressed all of them, or at least thought about it.
It's worth noting as well that everyone will get copies of the slides.
Yep. Okay, that's
so you don't need to be furiously writing notes on everything.
So if you're worried sorry, that's a good point, Chelsea. And other ways we can add value as well is just with insurance, we can look at the statistics and show you when it comes time to, I'm paying too much. Well, how am I going to keep the insurance but manage it in a way where I'm going to be still protected? Something like income protection, the statistics are that if you have an insurance policy that lasts for the 5-year benefit period, which is quite a lot cheaper than to age 65, 95% of all claims are covered off at that point. So there's only 5% that go on past 5 years. So the way to look at that is we bring that to someone's awareness. At least they can decide whether it makes sense for them or not. And they know there's a potential saving, but there's a risk, and they could be in that 5%. But at least you can look at all the components of insurance and you can see where we can make it as affordable as possible. Because the last thing we want is people not to be able to afford to have any insurance. We want to make sure the package works, but they've got other objectives too, like retirement and school fees and paying off home loans. Just a quick one here. We offer a claims guarantee. So any client who has an insurance policy with us that we look after, if they have to put in a claim, we'll help them manage the claim, get the money for them. It doesn't mean they'll always get paid because maybe their policies doesn't cover that, or their condition itself isn't, it doesn't meet the definitions. But we'll help them determine that initially so they don't waste time, and then work with the insurer to make sure they get paid the money as fast as possible. We know we'll skip through all that. Sort of like towards right at the end, but just our process as planners is that, we initially sit down with someone in the discovery phase, really get to know someone, understand where they are now, where they want to get to, what's important to them. So we address that meaning bit. And then from there, we'll work through the live cash flow modelling to build the big picture for them. And then out of that will fall the specific advice that we need to do with them to help them achieve their goals. So which super fund, which asset allocation, do they need trusts? Do they need self-managed super fund?
But in this step, you work through the risk profile. Is that the main thing?
The risk profile is definitely part of the discoveries, where we want to understand who they are, what type of risk they can tolerate to achieve their goals. And in the overall modelling side that's where we demonstrate that you can handle X amount of risk, but it's not enough to achieve your outcomes. So what other trade-offs can we do? So the discovery plus the modelling is where we've built that big picture with the meaning behind it. And then the implementation or the advice is the specific plan that comes out of that. And that's where if we need to work with the experts to get the specifics right, we will. And then let your team, your accountants, your lawyers, your finance specialists, and we've got them all here so everyone can help out. And then we'll help you implement it. So basically what that means is we'll get everything, the paperwork done, we'll get everything done so it's actually, it works for you. It's not just a plan. And ongoing wealth programs, we just make sure you've got a plan in place. Let's keep it in place. Let's keep it on track. And that's where we'll make sure all your financial house is in order, so all your documents are always up to date. Make sure that any superannuation insurance is properly reviewed. We do the cash flow exercise every year to make sure it's still on track. And you can see there that why we have it is probably the picture tells 1,000 words, but it's not always smooth sailing.
When we skip across to the Q&A, we might need to start presenting from this because that's about to die.
Right, okay. Okay, so well.
Apologies, my laptop wasn't meant to be an integral part of the presentation today.
Yeah, no, that's true, but we've done quite well, Chelsea.
Yeah.
And we work. I had slides just in case, but we're not going to go there on the investment, the investment outlook, the investment markets outlook, the portfolio positioning, and all that. That maybe we can deal with that in or the slides will be available. So if you want to drill into that, then and get back to us about some of the points raised in the macro portfolio component, we can address them with you.
So you're now on this one.
Okay. Oh, yep. Okay.
Seamless transition.
Seamless. You've done a good job.
Yeah.
So we're now on the Q&A. So if anybody's got any questions, now's your chance. Fire away.
That includes online as well.
So I've got a question. So how do they get in contact with you, James, to start that process?
There we go.
It's right at the end.
Thank you.
Thanks, Shane. That's getting in contact is the last slide. So you can just give us a buzz or send an email. Happy to just have a chat. Always happy to at least point you in the right direction, because not everybody, you know, we can't necessarily help everybody, or we don't need to. They just might need the right just pointer, or they might need to speak to the right people, something along those lines. So we just at least going to help them in that phase.
Any questions from the online cohort? That's all right. There will be.
Actually, I know you've got
So
champing.
I'm interested to understand. I guess I'm keen to have a look under the bonnet. And so say I come to you, I've got $1 million to invest. We work out that I'm high risk, and I want to just give the money to you to manage. Right? What will you be investing in, and who's going to be managing that money?
Right. Okay. So we do that is in the slides at the end. So what I'll do is I can
flick back, and if it goes, it goes.
Yeah. Okay. So we're running out of battery on this. So I will give you an example here. So if you're in a high growth or growth investor, you're going to have more of your portfolio geared towards shares than you're going to have the cash and fixed interest. So in this case, the portfolio will with our preferred portfolios, we want most of our investments to be direct, so listed, so they can be. So we spoke about the unlisted asset problem. So in fact, almost unless someone specifically wants something else, they are always listed. They're always liquid. So we've got our Australian share portfolio. So when in your portfolio, you'll right now these are the specific shares people own in the Australian component of the large companies. So it's broken down into large companies and small companies. So over here is the large ones, and then
this one here, I'm going on this.
Yeah, go. Can we see that? Yeah, next that's the small cap. So that's small to medium. So it's broken down into those components.
Yeah.
And just keep whizzing through that, Chelsea, if you can.
That's all right.
So
and then we got our international shares. And we've got an income portfolio. So they're broken down into that component. So international will be like your Apples and your Berkshire Hathaways and your Microsofts, Johnson & Johnson, Costco. So you'll have all the quality names that you know, but you'll own them directly. And there is some diversification on the international shares outside of the US. So that'll be more through ETFs like European ones, Asian ones, to give it a bit more diversification around the world. And on the income side, what they do is they've got government bonds, which they're starting to increase steadily, because as the rates go higher and higher, government bonds are now becoming a useful investment tool, because once you cap out, get to the top of the rate cycle, the next move is actually down. Either you're going to sit in those bonds and enjoy the higher income, or the rates are going down and you're going to make a capital gain, which is the complete opposite. That's what's happened in the last year when the interest rates went up, bond prices fell heavily. So all those people in those government bond type investments lost money. But our portfolio manager had the majority of the income funds in zero duration, meaning they weren't affected at all. There's the hybrids, the bank hybrids, which we were going to show you some of them, but
we will send all of the slides, and we do greatly apologize for the technical difficulties.
Well, ideally, we would like to show. I mean,
there's also a time component.
There's a time
as well.
component. Yes, you're right.
But that's all right.
But in terms of the portfolios, we want to keep them direct. We want to make sure that you can actually see what you own, and we want it to be largely actively managed for the people who want that approach.
But all shares are in minor.
Yeah.
In direct shares.
Yep. You're the beneficial owner.
If there's no further questions from online, what we might do is wrap it up in terms of the online component, and obviously we will be sending out the slides and all of the information tomorrow, and if you have any questions for James, you can shoot them through there. So thank you to everyone who joined us online. We will, if you have any questions, shoot them through. We will be sending through the recording and the slides tomorrow, so look out for those. And thank you to everyone who did join us online. We really appreciate it. And we will be sending out for feedback as well. And thank you for bearing with our technical difficulties.
Thank you.